All right. Let's see if I'm live yet or not. I'm not sure. If I am live, let me know in the chat. I see Mansadusa says, catching my first live. What's up, Mansadusa? Welcome in. We are about to review Fed Chair Powell and talk a little bit about what's actually going on in the economy and especially regarding the politics right now. We still have a government shutdown going on, so that's a major issue that is starting to actually affect real people in real life. And let's get to it. So, all right, I think I'm live. Joseph says, "Yo, what's up? Rates dropping," says Francisco Nuno. I think so, my friend. I think that is what is going to happen. Um, Let me go ahead and quickly just pull up the Fed Watch tool so we can see what. We're about to get the decision in 2.5 minutes. So, but anyways, let's look at the Fed Watch tool real quick. It looks like 97.8% chance that we get a 25 basis point dip. Okay, because we're at 400 to 425 is the window at the moment. It's going to drop down 25 basis points. So that's pretty much a given at the moment. Let's also look forward to the next one in December. Also, pretty high chance that we get another rate cut. Okay, so we're going to get 2 rate cuts here before the end of the year. And that's what's going on. So let me check out the chat real quick. God bless America, says Christian Perez. Kareem, appreciate you. 25.50. Yeah, just 25 basis points today, guys. That's all we're looking at. The real question is going to be, is the market going to buy or sell the news here? I think the rumor is going to be having bought and then sell the news. Let's pull up some charts real quick. Okay, so technically we have had a little bit of a dip in the S&P 500 before this moment. But truth of the matter is, I wouldn't be surprised by a little bit more selling. So we had the market open on Sunday with a major gap. So we have a new week opening gap is what we call this in, I guess, the ICT world, really just what it is. But this is the S&P 500, to be clear, the futures of the S&P 500. And so when you see a movement like that ahead of a rate decision, I'm personally going to be looking for us to come back and fill this gap in at some point throughout this week. Doesn't have to be. Most of the time, that's what you're going to see in the markets. Let's take a quick look at Bitcoin. Bitcoin has been acting like it wants to do something. I'm personally not convinced. I do see us potentially coming down here before we end up actually going any higher. Been talking about that a lot inside of my private group. But anyways, yeah, not too much to look at there. Let's pay attention to what the Fed is doing here. Y'all know I like to go to forexfactory.com. We got 10 seconds. 10 seconds. 3, 2, 1. And after this, I'm going to dive into a little bit of the macro situation. So just kind of letting people roll in for a second. Let's see. We're pending. Pending. And 25 basis points. All right. Let's see how the market reacts to this. I'm going to go to the NASDAQ, actually. And we've got some really cool news stories today. So we have, obviously, the government shutdown. All right. It's now the second longest in history in the United States. We also have Trump going out to South Korea and has been doing his Asia tour, trying to get some deals signed with the countries over there, including obviously with China. We have this Argentina bailout that the government just did and essentially trying to save some of their industries. We'll talk a little bit about that. And we'll also talk about the fact that NVIDIA has just become the first $5 trillion company. So definitely something that we want to chat a little bit more about. So right now in the market, I'm not really seeing too much of a reaction here. Let's zoom in real quick. I'm going to read the chat in just a second before we start diving into stuff. But we got 30 minutes until we get to hear from Powell live. So I'll yap for a quick minute. Let me see what you guys are saying. Bye, 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 says D Cartel. Just buy Chainlink and shut up, says Cal. Ooh, interesting take. Why would you not be surprised by some more selling? In Bitcoin, I'm guessing you're talking about. The major reason I'm not going to be surprised by more selling is because I think we still have a lot of over leveraged traders in the market. And there's just a lot of structure in my eyes that says that we're probably going to go lower. Um, let's see. Do you think BTC will hit all-time highs before 2026? Do I think BTC will hit new all-time highs before 2026? I really don't know. What I do know is that if we do get a sell-off before we go higher, I think that would be a really good sign. Personally, like I just think that there's more liquidity that needs to be taken out of the market. And after that, yeah, I'd be very confident that pretty swiftly we could go higher after that. Are we revisiting 92.5 before launching? That I'm just going to be honest. I'm expecting us to go below 100K before we hit a new all-time high. Lowering the rates indicates issues. Yeah, that's definitely one way of looking at it. At the end of the day, like you lower rates because you want to make sure that there's more investment in the economy. And usually that's at a time you're going to make that decision by the time you've gotten data that says that things are not going well. And definitely as far as the unemployment picture, it's clear that things are not going all that well. So that's definitely one major way of looking at it. So, all right, let's talk a little bit about like what's actually been going on behind the scenes here. First thing is that the U.S. government shutdown is been going on now for I think it's like 28 days, and we're coming up on potentially being the longest government shutdown in history, which I think was 34 days. We have 900,000 federal employees that have been furloughed, with 2 million more working without pay. Essential services like Medicare, Medicaid, and airport security are running, but with disruptions, delays, and other reduced staffing. So, right now, the biggest issue that has been coming up in the news is that federal programs, including SNAP, which is food assistance, WIC, and Head Start, are all at risk of running out of funds by November 1st, which is in a couple of days. So, states like Virginia are declaring emergencies to cover critical programs temporarily. There are growing delays in air travel and federal benefit approvals, which is continuing to put more pressure on lawmakers. And from what I'm seeing regarding the negotiations in the Senate, is that talks have like been more prevalent, but both parties still remain deeply entrenched in disagreements. And there's been multiple attempts to end the shutdown, but they've all failed now over a dozen times. So there's been some bipartisan attempts in the Senate that have seen no real push forward. So definitely not a great situation there. It seems that like if we continue down that path, things will get pretty ugly. Trump has made some temporary fixes, including using private donations as a way to potentially pay military salaries. I don't know for sure that actually has gone through or not. Uh, have you guys seen that he's actually pulled that off already, or is that just something that he's been thinking about trying to do? Um, okay, so let's see what some of the comments are saying real quick. Oh, what the Foz was asking in general. Why am I not surprised by more selling? Oh, okay. Yeah, I mean, well, right now I think that the market is just in an unsteady place. Right now there's a lot of uncertainty at the moment, and anytime you have a big gap up in the market before a major data point like what the Fed rate decision is going to be, I'm going to look for that gap to get filled. So I'll pull up the chart one more time. This gap that we created as we opened a new week, to me, is a major target for what could happen by the end of the week. Now, that's pretty far from where we are, so it might not happen this week in particular. Let's also look at the QQQ to get a better angle on what the actual institutional side, the spot market would look like. So Friday closed at this price level and Monday opened at this price level. So there hasn't been an opportunity for anyone to buy or sell in this region. And I'm not going to be surprised by markets coming back down into that area. But let's see. Michael Saylor predicted 150K end of year. Yeah, we've had some pretty big predictions. I think also Tom Lee was saying something like 250,000 or $200,000 Bitcoin by the end of the year. The thing about Bitcoin that I think a lot of people underestimate most of the time is that um, like it can move up really fast and you don't even really notice it in these types of environments because especially when Bitcoin is just like trading over $100,000. Like, yeah, it just goes up to 150 and you just don't even really think about it. It looks like Powell is already speaking. Interesting. Okay, yeah, I don't know about that. But thank you for definitely keeping an eye on it. Maybe I'm still missing out on something. Okay, how do you feel about the 4-year political cycle midterms? How it has influenced markets over history? I don't know if I'm old enough to really give you a real answer to that, nor have I studied it myself. Rather, uh, I think we're definitely going to see right now. The major thing is like markets are very dependent upon what the guy in the White House is doing and saying, and I think that's a really big deal and something that it keeps us from having any idea of what's going to come next. I mean, beginning of the year, we had a major 20% drop in the entire market based upon his decisions. And then the market immediately recovered and has been roaring past new all-time highs ever since then. So, um, could that continue for the next few years? Maybe. Uh, we have such a volatile situation that, like, I hate to say it, but like, if something were to happen, right, to our leader, then like that could definitely change things a lot as well. Um, I want to go ahead and get back to my stories real quick because I think we have some interesting stuff going on. So, right now, Trump is over in Asia, South Korea in particular, and apparently today they've gotten much closer to signing a deal. At first, he said he was confident ahead of a deal. Oh, this is about the Chi deal, but he also ended up doing some stuff with Korea, South Korea. So, let me read out what I saw there. We saw that essentially Trump and President Lee Jae-myung finalized details of a long negotiated trade and investment deal where South Korea will invest around $350 billion in the US to avoid harsher American tariffs, and $200 billion will be paid in cash over several years, capped at around $20 billion a year, and $150 billion will be will fund joint shipbuilding projects aimed at revitalizing U.S. industry. So I guess they're getting South Korea to invest in American industries through shipbuilding, and also 200 billion that's being paid in cash. That part I'm not sure I fully understand. It says that profits from these projects will be split 50-50 until the initial investments are repaid. And let's see. So Trump, according to this article here, Trump expressed optimism about his upcoming meeting with President Xi, saying that he's expecting a good outcome for both countries and the world. Now, the major thing about that, so let's move on to talking about what's going on with him in China. The big thing here is there's been obviously a major trade war tension. And um, China recently proposed expanding export curbs on rare earth minerals, okay, which are critical for high tech industries, silicon, right, chips, AI. And so when that happened a couple weeks ago, Trump responded with threats of 100% tariffs on Chinese exports and to put new export controls on US made software that's used in China. And so that was kind of like the most recent escalation. We saw that obviously in the markets right here, right when we had this big red day. It was like a 3% drop in the NASDAQ in a day. And ever since then, they've kind of been like, all right, let's hang out and let's kind of like come up with some ideas of how we can negotiate a deal. So, what China is wanting out of this is they're wanting to get a lift of the 20% tariffs that have been in place, I guess, since earlier this year, and an easing of the tech export controls and a rollback of new port fees on Chinese vessels that apparently have just come into play. So right now, what analysts are saying is that they expect only a temporary de-escalation and not a comprehensive deal out of this week's meeting. And major US complaints such as market access and Chinese industrial overcapacity are unlikely to actually be addressed this week. Um, we also have obviously these Taiwan tensions where the talks occur amid a heightened military activity around Taiwan. U.S. officials are insisting that Washington will continue supporting Taiwan's defense and won't trade it away for concessions from Beijing. So the major thing to take away from all of this, I think, is that like we're not expecting to necessarily have some major trade deal out of this week. I think what we're really more looking forward to is just some sort of de-escalation or a delaying of any harsh sorts of penalties from one another until they actually get stuff figured out. So that's what I'm looking to see out of what occurs here this week. Let's see what you guys are saying. Is this bullish with crypto? How do you feel about the 4-year political cycle? Prediction for Bitcoin by the end of Trump's presidency. Well, that's kind of tough because it'll be another 4 years from now. So really, it could probably be like exactly where it's at right now, or maybe even lower, even if we were to get a huge uptick in between all that. When will Jerome Powell talk about their decision? Oh, it should be at 2:30 Eastern. So um, unless I'm missing something. So let's see what you guys are saying. We had future trend today. Hello, hello. 25 basis points was pricing over the weekend. Yeah, yeah, exactly. When we got that open higher, I think that was kind of enough to say, all right, that's the end. Um, Someone said some stuff about XRP. I'm not sure where that came from per se. What about silver? Yeah, let's take a look at silver. I really haven't been looking at silver since the beginning of the week. And so silver and gold have had a nice retracement so far. I think um, this is very healthy. Wow, that's a 15% retracement on silver. But once again, very healthy. Let's zoom out a little bit on the weekly chart and look at what's happening here, right? We've had an explosive move and not a lot of opportunities for someone who wants to buy this asset to buy it, right? Because it's just gone straight up. Same thing with gold. And so this retracement right here, although it is pretty dramatic, right? A 15% retracement in a couple of weeks is pretty real. But it's healthy, right? If you were to want to continue this trend higher. And I'm personally not going to be surprised if we do get another run higher in silver and gold. So we want to see this type of a movement for gold, a 11% retracement. Also, once again, very, very healthy for the type of trend that we've been seeing. I saw some memes this week that someone was like, someone saw this chart and thought that it was a good time to buy, like buying right up here. And to be fair, I think that's a fair statement to make. It's a fair joke to make. But at the end of the day, there's a really good chance that what we're seeing in gold is just starting to begin. It's the very beginning of what's actually happening there. Potentially, we'll see. Um, I think the housing market is tricky because the buyers are people like BlackRock and other investment companies. It's not so much normal people buying a house. I think we see an immediate dip. I think you're right. There's a lot of data around these private equity companies and investment firms going up and buying up single family homes in particular. And that is definitely going to have an impact in real estate markets over time. They um, don't need cash, right? They want the asset. So they're willing to potentially, I think they're willing to stick it out a lot longer when prices do go down. They won't necessarily sell at a loss, which might actually be positive for prices. Um, let's see. That Kung Fu guy says, check it out. Midterm years tend to be corrective years. There we go. So Gerardo said, but long term, I still think home prices are a safe asset, at least for Americans. You got to remember, a house is a house. Yeah, I mean, yeah, I feel like I'm in a very weird spot with that. Like, I don't really, I personally just don't play in that space. Um, People always will need a place to live, but I don't necessarily think that they'll only always need a house, right? So that's kind of how I look at that. Um, People will always need a roof over their head, but a house, I don't know. And so when you get to where, like how we are today, where a house kind of becomes a luxury, which is, I think, kind of what it is today, I think it becomes less of an investment and more of like a Rolex, if I may. And I know that people buy watches as investments, so I understand that. But it's one of those like, yeah, is it really an investment, or is it something that you really wanted and that you've justified by calling it an investment? But you don't really care if it goes down 20% in price, right? Anyways, um, Josh said, I think we'll see a longer liquidity cycle that goes over the expected Bitcoin 4-year cycle. Wow, Powell is right. Let's look at M2 or M3 even. M2 continues to climb. um, there's been a lot of research done saying that Bitcoin ends up really just being a measurement of liquidity. And when you look at M2 as a potential way of looking at liquidity in the market, when M2 is just money supply overall, pretty broader money supply. And, I think that we're not going to, if we continue to see M2 continue to rise like this, yeah, we'll probably see more investment in Bitcoin, right? Companies have more cash, more money's in circulation, less places to put it. Interest rates are going down, right? So I have to find places to put my money, but I can't put it in the bank. I can't put it in money market funds. I'm going to have to find something risky to put my money in. What is it going to be? Is it going to be what some consider the hardest asset that exists in the world? Can't be created, can't be controlled, now being institutionally adopted. Maybe they start putting money into Bitcoin and other cryptos. Um, Definitely when you see lower rates, right? That's what you could expect. Um, Whether or not we have to go through some major pain, I'll continue to, be careful here. Whether or not we still need to go through some major pain to get to where that's what's happening or not, that's to be seen. I'm not going to be surprised, guys, if we go under 100K Bitcoin. Just going to be honest. All right. Jay Heron said, please read mine all together. Okay, let's try that. Let's try to do it. Oh. Okay. Okay. Yeah. I'm trying to not go too deep into that stuff, Jay, but I do hear what you're saying there. Can you guys even see me? I feel like this isn't okay. Yeah, never mind. Okay. So Raphael said he wants a third term. Yeah, there's been a little bit of talk about that. There's been a lot of talk about Mr. President here in the United States looking for a third term, and truth is, apparently there's ways for him to do it. I watched this clip from Steve Bannon. I might have to just pull that up for you guys. Yeah, that's definitely worth pulling up. It made me laugh. I thought it was funny. I was like, "Oh, this is funny." Steve Bannon was a previous advisor, I believe, to Trump. In his first term, he ended up getting fired, and there was some like controversy. But I guess Steve Bannon still kind of backs him. But let's take a look at something that he said. What are you guys thinking about what's happening in the market right now? There's one other story, by the way, I'm forgetting. So, guys, NVIDIA becomes the first $5 trillion company. And that right there is a really big deal. I'm going to quickly pull that up and show you guys what I'm looking at with that. And then I'm going to show the Steve Bannon clip because it's really funny. All right. Never mind. We're gonna watch this clip first. Let me see. Let me know if you guys can hear this. Oh, you guys can't see
At the
it.
appropriate time, we'll lay out what the plan is, but there's a plan. We had longer odds in 16 and longer odds in 24 than we got in 28. And President Trump will be the president of the United States, and the country needs him to be president of the United States. We have to finish what we started. Trump is a vehicle. I know this will drive you guys crazy, but he's a vehicle of divine providence. He's an instrument. He's very imperfect. He's not churchy, not particularly religious, but he's an instrument of divine will, and you can tell this of how he's pulled this off. We need him for at least one more term, right? And he'll get that in 28.
You're not driving me crazy. I'm trying to understand the coherence of the things you've just told me. On the one hand, you've said the Constitution is fit for purpose. Secondly, you've said that President Trump needs another term, even though the 22nd Amendment makes pretty clear that he cannot have another term.
Why does it make that clear?
Because he's on his second term already.
At some point in time, we will make sure we go through Zanny and define all those terms.
But you will be undermining the spirit of that amendment, even if you find some way around it.
If the American people, with the mechanisms we have, put Trump back in office, are the American people tearing up the Constitution? Would that be tearing up?
Well,
would the American people be going against the spirit of the Constitution, ma'am?
I think yes, actually, because I think what you will end up with is a populist justification for a quasi-dictatorship.
That's not true at all. Trump
That's what it sounds like.
It's not. Trump is a dictatorship. Did you just see the compromises he had to make on the big, beautiful bill? You see the compromises he has to do on everything, on accommodating Zelensky, on what President Trump. President Trump is nothing but a series of negotiations to kind of keep this thing rolling forward, where he's having trade-offs all the time.
But Steve, you've just spent the last 20 minutes telling me we have to smash the other side. There's no room for debate. There's no room for compromise. We must smash them. And now you're telling me this is a negotiation. I mean, that's
no.
I guess that's why it seems to me some kind of tension there.
First off, the only way President Trump wins in 2028 and continues to stay in office is by the will of the American people. Okay? And the will of the American people is what the Constitution embodies. And so I think we're going to be in good hands there. We need to finish what we started.
What do you guys think of that? I gotta know what you guys think of that right there. Let me see. Let me. I think I figured out how to run a poll recently, so let me try that. Is Trump going to serve a third term? Do you guys see that happening? Let me see. Yeah, I'm gonna run a poll. Yeah, Cameron said with the mechanisms we have. Yeah, man. Exactly, bro. It's interesting times here. Interesting times. Using the rule book all the way to the absolute maximum. And in a way, I get it. I get it. Okay, so we got 24 votes. Vote on the poll. Will Trump serve a third term? Let me know what you guys actually think on that. And with that, let's talk about the fact that NVIDIA has now become the first $5 trillion company. Okay, we've got this guy, Jensen Huang, as well, CEO and founder. He's now the 8th richest man in the world, with his net worth hitting somewhere around $179 billion. Huang also unveiled recently a $500 billion AI chip order on Tuesday and said he plans to build 7 supercomputers for the US government. Okay, so look at this. And this was super cool to see. So NVIDIA's bull run is leaving the Magnificent Seven far behind, right? So look at the outpacing that NVIDIA has done compared to the rest of the Magnificent Seven. I mean, wow, right? It's pretty much carrying the entire S&P and the NASDAQ. Putting in work, Jensen Huang has been. And honestly, I respect him. Like the way that he has gone so hard on building this company out, and honestly has had the way that he's kind of really taken advantage of the opportunity that America has presented is just like unmatched. There's a lot of people in the AI space that are questionable people, but like This guy, I don't know. He's fantastic, and he's great to listen to. The one thing that I will say, the one thing that I do want to say about this whole AI thing, these people do not care about the fact that there may be some really big issues that we're going to face, right? Like they don't care. And this is why. If you're going to become the richest man in the world by continuing to do the business that you've built out, not necessarily knowing that this was the direction we were going to head in, it just turns out, oh, okay, this AI thing is the thing. Well, guess what? I'm gonna build that company. I'm gonna do that thing, and I'm gonna play the game the best that I can. This the capitalism game. And if I win, then I win. And obviously there's no just like winning the game, but I'm just saying these guys have every incentive to continue to build this AI stuff and not think about what the consequences are going to be. They have no incentive to care, right? The incentive really isn't there. The only metric that they're using is profits. And I'm not saying that like, oh, they're such evil people. I'm just saying that's the incentive of the system that's in place is for them to worry about profits, cash flows, returning dividends to their investors, or at least raising shareholder value. So, anyways, so with that, they don't care about the ethics or the challenges that it could bring on a societal level. That's not their job. That's the government's job to try and figure out from the perspective of right him as an entrepreneur. Let's see what the actual total votes here are going to be. Everyone's saying 69% are saying no. 32% are saying yes, Trump will serve a third term. That's pretty high. That's pretty high. I'm not gonna lie. And then Raphael said, I believe we get an H bar fund this month. You mean like the ETFs, Raphael? RM said, did you read Ruby Payne, The Hidden Rules Among Classes? No, I have not read that. Okay. Which, yeah, okay. First $10 trillion company incoming by 2030. Oof. It's going to be really fascinating to see how this continues to shape up because you got Amazon, you got Google, you got uh, NVIDIA. I think NVIDIA is not going to be there. You've got Oracle doing all this stuff. I think NVIDIA is not going to be there. I honestly think that NVIDIA has its moment right now. And from there, I think we're going to have other players who are building on top of the platform, which being their chips that they have, are going to be the real winners of all of this. The software and or some of the more applications of the hardware is where I think the value is going to actually accrue. And or also you could go a layer deeper and look at the energy companies. That could also be a way in which a lot of this value ends up accruing over time. So why are you even entertaining this notion, Keith? Have you seen the way that things have been going so far? I'm just gonna be honest, like what he's been saying has been going. So if this is what he really wants to do, I wouldn't be surprised by it. January 6th, when that occurred, by the way, there was a whole moment that I had in my life because I kind of, well, he put it out there, right? So, but I understood and I listened when he said, you know, there's going to be this storm. So I was like, I was talking to one of my parents and I was like, listen, I want you to turn off the TV today. I don't want you to watch anything because there's going to be some crap that's going on. And I told them, don't turn on the TV. And they were like, is something wrong with you? Like, you all right? And then later that day, January 6th occurred. My point of all that is being that this guy, uh, he's bending all the rules. So I'm not going to be surprised if he bends that ultimate rule or finds a way to, if that's what he wants to do. All right. Jerome Powell is about to come up. So I'm going to be quiet while he speaks. Um, yep. All right.
Down of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This is going to be pretty interesting here.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll feel they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, people, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world, and big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think If something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, And that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor
So
market?
we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of
of?
the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right. So I will admit that I think there was one major thing to take away, if it wasn't clear, which is the fact that they're going to stop the runoff of the mortgage securities on the balance sheet, which is a pretty big deal. So essentially, to break down what that really means, I believe it's around 2020 when the Fed started, easing very hard, buying lots of treasuries. It probably was before then, or I mean after that this really occurred. But the Fed bought a bunch of mortgage-backed securities. Buying bonds or any securities of that nature is going to lower the rates, right? So they kept rates of housing rates a lot lower, mortgage rates lower, and since then they've been letting them run off the balance sheet. So instead of like just selling them right back to banks and forcing banks to buy them back, they're letting them run off the balance sheet, meaning that as those mortgages come mature, right, that they're done being paid off, they don't reinvest into these mortgage securities. Instead, they just kind of let them roll off the balance sheet, decreasing the overall holdings of the asset side of the Federal Reserve balance sheet. And so that was kind of probably the biggest thing, is that they're going to stop doing that, which is, and by the way, so when they're letting that run off the balance sheet, it's a tightening kind of mechanism. And so now they're going to stop that tightening mechanism, as well as what we're probably going to see as well is the reduction of the federal rate as well. So in this discussion, he was asked about whether or not it was okay if the market is completely saying that for sure we're going to get that next rate cut in December. He said that it's not a completely done deal, right? We still have to continue to look at the data, even though they're not getting the data is the major thing at the moment, because the government is not releasing all of the data, at least not in a timely fashion. And so they don't have all the unemployment data. They don't have all the figures around, for instance, it took a little bit longer to get the CPI. We don't have the PPI. And so there's like a lot of things that they don't have. So one of the analogy that he made during the speech was, if you're driving down a hill or if you're driving in the fog, what do? You slow down. And so basically that's what he's saying, is that they need a little bit more data, or at least need to wait for things to get back in motion before they start making decisions about what they're going to do next. He said as well that he's looking at some of the private sector data, looking at things like the ADP data, and he mentioned Adobe data. I don't know anything about that. I find that interesting if you guys know anything about how they're looking at Adobe data. So anyways, I think those were pretty much the major things that I thought were interesting about this. We can pretty quickly go ahead and look at the markets and see what we got there. People pointed out earlier that we had this major kind of push back up in the market after we had a little bit of a dump. So this is Bitcoin at the moment. It kind of whipsawed a little bit, right? It went down at first, and then now it's starting to pick back up a little bit. But to be honest, in the grand scheme, like nothing has really occurred here. But anyways, those were the major things. I'll keep looking at my notes here and see if there's anything else that I wanted to talk about real quick. I think he did mention that like there were more disagreements about what's happening in December versus this time around. Basically, some people are saying that they're seeing the economy pick up, and it feels like things are strong. He mentioned that there's like stronger consumer spending, and that makes it look like things aren't necessarily all that weak, and that the labor market won't be too bad in the near future. But others are so instead of continuing to lower rates, right, in that regard, to try and spur more investment and more hiring, that could also, if they lowered rates, lead to higher inflation. And some people in the Fed are more worried about that. But then he also said that someone for this time around was looking for a 50 basis point cut, which is very interesting as well. So we have potentially a little bit of division within the Fed. That was another thing that commentators or reporters were asking about as well. Let's see. Oh, and then I didn't hear too much about the Amazon layoffs before this, but apparently a day ago, Amazon announced 30,000 people are potentially going to be laid off. So that's a really big deal. And this has been quite a theme throughout the year, is these large technology companies, especially these really big ones, are apparently getting ready to lay off, or have been, laying off thousands and thousands and thousands of employees at a time. And, Amazon laying off 30,000 of their corporate jobs, by the way, is what it said. That's a really big deal. Let me see real quick, because I'm seeing 14,000 right now, but then I'm also seeing UPS also taking out its operational workforce by a nice amount. And so, these layoffs in the tech space are happening at a massive pace. I remember, when I first started the channel, we were kind of talking about this, and it was at that point, there was like, I don't even remember. It was like, I don't even remember how many jobs it was, but right now we're definitely looking at probably over 100,000 layoffs from some of these larger tech companies this year. The only other thing that I wanted to touch on was this AI thing. So we had him being asked about AI and whether or not, the rate decisions are going to have an impact on that. And he said that no. So I wanted to speak on that a little bit because, like, okay, maybe not. He's saying that these people that are investing in AI are looking for major, massive returns. So, like a 25 basis point cut or 50 basis point cut is not going to make a difference in whether or not they're going to go through and make these investments or not. Well, okay, maybe. But there's two sides to any investment opportunity. One of them is the debt side, okay, and the equity side. So you have the equity investors in a lot of this opportunity. They don't really care that much about you know, 25 basis points. But then you also have the banks and the institutions that are lending money, and those, you know, basis points are their entire business, right? Like that's what they do is they make money on the spreads. And so listen, even for the bank or a lender, like 25 basis points on a 10% investment opportunity isn't going to be a massive change of how risky that investment is for you, right? Um, if you're expecting these companies to be able to pull a 20% return, then like, yeah, like a 25 basis point change in how much uh, isn't going to make that big of a difference. But what it does do is it makes these banks and these lenders more aggressive with how they're going to lend and make them a lot more willing to lend money in those environments, right? So the bulk majority of money that's moved around in investment opportunities like is usually debt, right? Like when you look at real estate, for instance, like most of the money in those deals is going to be debt. You're going to put 25% down and then you're going to raise 75% cash. If you're doing, if you're acquiring businesses that are cash flowing assets and you might get a loan from the SBA, like there's certain situations where you can put down 10% and have 90% of that deal being financed. So the debt side of the stack is usually going to be the largest amount, right? That's being put up. And so when you can increase the returns that you're going to get from that debt side of the equation, then that makes a really big difference actually over the long run, or also just at scale when we're looking at who's getting, how are people getting the money to go out and make these investments that they're making. So, anyways, just wanted to add that to the equation. I'm not saying that he's wrong in saying that it doesn't matter what the rates are in the economy, but it's just wanted to kind of like teach a little bit about that and how to look at that from the investment perspective. So, yeah, check Dixie. That's a good point because I haven't looked at Dixie at all throughout all of this. Let's look at the dollar index real quick. Oh wow, yeah. See, that's actually getting some push. So the dollar index has been in a very ugly range for quite some time. Right now, it's getting a little bit of a push up based upon today, which is I don't really know how to come up with that, but it's been a very choppy range in here. It's not really too clear what it wants to do, but going higher here, if we can actually come up and make it back above 100, that would be pretty telling in saying that maybe we do want a higher dollar after we've had a pretty precipitous drop throughout this entire year. Yeah, over 10% down on the year, or at least since, yeah, on the year. So let me see what else you guys are saying real quick. Yeah, Adobe data. Yeah, I'm pretty sure he said something about Adobe data. He said ADP as well. So I know um, that was that. So it's a bridge company. Yeah, UPS laying off 48,000. Like, wow. Yeah, the 50 basis point cut must have been Myron. Yeah. Andrew, it probably was. So NVIDIA bubble popping or shooting. Man, the thing that's the scariest about NVIDIA for sure is that all it's going to take is a little bit of a sentiment change. And yeah, that could be really bad for anyone who's buying it now, right? So it's like another thing about these types of runs up that you get in these companies is people forget that like the major holders of NVIDIA have held it for for a very long time and have held it at very low prices. So they don't really care if they get a 50% pullback in the price. They're still up thousands and thousands of percent. So the people that get hurt are the people that have been buying it over the past couple of years. Um, Gabriel, that was Moran. Yeah, it probably was. Let's see. Johannes says, will AI cause layoffs in economics and finance jobs? Yeah, I saw a little bit of back and forth about that in the chat as well. It's like, is it going to be um, more manual labor jobs or white collar jobs that get most affected by AI? I think it will probably a little bit of, I mean, it's going to be both. I think what I've been hearing, right? I'm not super deep into this, is that The physical jobs actually can be a little bit harder, and that's logical, right? When you think about it, knowledge work is actually the thing that is on the chopping block because a lot of that can be automated away. I think if you're not a creative, like I think creatives probably have the biggest moat in a situation like this because it's hard to replace that. That's going to be pretty much impossible to ever truly replace is the creative aspect or like really writing and making people's emotions move, right? And using that as a way to build some sort of economic uh, platform. But the average knowledge worker, the accountant, the even okay, let me slow down. The accountant, the bookkeepers, the people that are doing some of the lower level white collar jobs, which I'm not super familiar with what that really looks like. Those things can absolutely be automated away. And then when you look at, but okay, so the thing about the physical manual labor stuff is this: the dexterity of the hand has been the thing that I've heard is like the most difficult thing to try and replicate. And so, yes, we have these robots that are being built. Like, let's be real, we're seeing a lot of crazy stuff with that, and it is happening very rapidly. But for now, uh, the dexterity of hands, the flexibility of the human body is something that is harder to replicate. And because of that, there are certain jobs that are manual labor jobs that will have a little bit more of a moat. Um, so, I think the exact examples that you guys were talking about was construction in particular. And like, I don't know anything about construction, so I really can't speak on it. But I do think that we're underestimating how much AI can take over white collar jobs, and we might be overestimating how much it can take over the manual labor jobs for the time being until robotics really get to where they need to be able to do that. Plus, the cost of the robotics also makes it a little bit harder. Like, truth is, you can hire humans a lot more cheaply than you can buy a robot at the moment. So until that changes, which it will, then those jobs have a little bit more economic security in that regard as well. So let me come back to the chat. And these are my opinions, my thoughts, guys. So definitely be free to disagree with me or provide anything that you guys are thinking about as well. Let's see. Samuel said, I work for Fortune 100 company, and in our last live here, I mentioned I just got out of a work meeting that laid off someone. Yeah, crazy amounts of layoffs happening at the moment. They laid off another two after that, said Samuel. Okay, gotcha. Yep. Um, Alex Ramsey said, working for a public company is a humiliation ritual. Tough, man. Akin to no one says, what do you think about his comment making a distinction between AI companies versus .com companies? The latter being merely ideas. Yeah, I think that was an interesting comment. And somebody else commented, they were like, because he said he believes that there are business models or whatever. He's like, I believe there are actual business models here and cash flows because he doesn't know. Um, and I think that's fair. Like, look, I'm not a business model expert, and when I look at AI companies, I mean, NVIDIA obviously has a real moat there. I think when it comes to these other software types of companies, it's going to be a little bit harder to determine whether or not they're going to be solid models. Like, does OpenAI really take the cake when you have Google competing? Over time, I don't know, right? Over time, and that's the thing about a business model and thinking about the ways that you actually monetize. Um, Now, I do believe that OpenAI will be extremely successful, but you just have to think about, does it get to the point to where all of their features should just get copied, and the platform that Google has built out as an advertising platform ends up just being more powerful when they copy those features, and then OpenAI could technically go away after that. Just as an example, just as an example. But if they find different ways to monetize that aren't just ad based, then they'd be competing in a totally different way than Google is, right? So just like that's kind of the thinking that I'm trying to throw around there. Um, are we bullish? Said John. You know, I would say for crypto, yeah. For crypto, yeah. Just give it some time though. Give it some time because, like I said earlier, I think we go down first. Overall markets, yeah. Markets are forward looking. We're cutting rates. We're stopping the runoff of the balance sheet. We've gotten through a lot of this tariff stuff. We're getting deals in place. That was what I was saying in April before I even started this channel. I was like, the risk is to the upside here. Everyone's freaking out about the tariff wars, but like the only thing that could have happened from that like Mayish point forward was that deals started getting cut, and here we are, deals getting cut. Things are moving in a better direction. Apparently, there's real revenues being generated from these tariffs as they are, and so that's just kind of how I'm looking at things at the moment. SCM Louis said, so if the dollar goes back up, is that bad for crypto? It definitely would be a sign that there's some sort of a value of dollars over potentially risk assets. I mean, at least that's how you can kind of look at the Dixie. They don't always move in inversely that specifically. What I would say is that a lower dollar would be good for crypto for sure. Let's see. Jay Heron said we should do a dive on the companies, the 31 that invested in the ballroom in the White House. That's actually an interesting thing for sure. We might do that on Memes and Markets. By the way, if you guys have not already subscribed to Memes and Markets, there are 229 of you who are watching this live. If you have not subscribed to Memes and Markets, it's in the link in the description of this. There's one link that's join the conversation, but then there's another one down below that says subscribe to Memes and Markets. Subscribe to Memes and Markets. We're going live every Tuesday and Thursday, and that's the place where we'll be doing those kinds of things, where we talk about basically everything that's actually happening in real time. Tomorrow, I'll probably, Jay Heron, subscribe if you haven't already. We're going to be talking about XRP ETFs and other ETFs that have just gone live this week, or excuse me, the other ETFs that have gone live this week and the potential for these XRP ETFs, what impact that could have on the price of XRP and other assets as well. So definitely subscribe to Memes in Markets. Let's see. SCM Louis, the dollar is already cooked. Yeah, the dollar's been absolutely trashed this year. Jay Heron said the hand is fascinating. I don't know what that's about per se. That phone case, I don't know what that says. I think Powell talked about higher interest rates and increasing unemployment being a significant risk. Isn't that stagflationary? Higher inflation and increasing unemployment. Yes, that's stagflationary, and yes, that's an issue. Okay, how do you think AI will change trading landscape? My idea is similar to current bot trading, and fast pricing is going up in scale to bigger news catalysts and faster liquidity matching. I actually, what's cool was Raoul Powell, guys. He actually just did an interview with, that's funny. I forgot the guy's name at the moment. He's got one of the top trading podcasts. Wow. And it was about that exact topic of does AI replace traders? So I highly recommend digging into that a little bit. I feel so bad that I forgot his name. I'm just gonna look it up real quick. Powell, AI trading. Is like Riz, I think is the guy's name. Yeah, Words of Wisdom. He said the title of that video is 99% of traders will be replaced by AI, Raoul Powell. So interesting conversation there. I didn't watch the whole thing, honestly, but I will for sure. He believes that it will completely replace traders. I'm thinking that trading will change, but I think that like the emotional reality of markets will always be there, and because of that, there will always be opportunities for traders. That's how I look at it. I could be completely wrong, but when you think about the psychological impact that like people will always want to have control over their money to some degree, and in that there will always be people making emotional, irrational decisions in the markets, and I think that that provides opportunities in asymmetric opportunities in the market. AM said, let's assume a trade deal tonight. I think it could start a blow off top. I think it's going to be a little bit less simple than that, but it could be a catalyst for sure. For sure. Gabriel said, to where the common man must have their own bots to trade unless they are trading in longer term time horizons, still losing some edge in the short term. Yeah, that's the thing that I think would have to happen, Gabriel, is you'd have to just extend your timelines. I think that's what would happen. And Cryptonomics said, Gabriel, AI has already been in trading for the last 3 to 4 years. I mean, I would argue that AI has been in trading since computers have been used in trading. Like, so that's my other take on that as well. Is it's just like I don't like we've been like what do we think that Citadel, Jane Street, and all these companies, like they are market makers that are automating their processes using very complex algorithms that you could consider to be artificial intelligence. So I that's kind of how I look at it as well. Cryptonomics. Um, Gabriel said, yeah, but in the shorter term. In the shorter term. Yeah, and that's exactly the thing, right? So Citadel and Jane Street, right? Like they're in the microseconds, right? Making these different transactions and decisions. And I think maybe you could see their time frames being zoomed out more. And then that, because they have more information that they can use that's more relevant over a longer time frame, but not on the 30-year time horizon or the 10-year or the 1 year or the 6 month. I don't know. Anyways, uh, yeah, Cryptonomics said, I don't think that will be required for the average person. Yeah, I don't know. I mean, I don't know if that would really make sense if everyone is creating their own bots. I feel like I'd have to think about that a lot harder. Actually, I'm not going to respond to that. um, Thoughts on the USCR coin thing? I have no idea. I have no idea. I don't even know what that is. Josh said, "What are your thoughts on Palantir?" Um, Somebody said volume too low. My volume is super high. I'm surprised that you would say that my volume is too low. Let's look at Palantir on the charts real quick. What does Palantir have to say? Oh my goodness. 200. Make you wanna. No, that's pretty wild. I actually haven't been tracking ever since we kind of like lulled around, but wow. Shout out to all the people that were buying Palantir back in here. I got some buys in, but it wasn't anything major. Let's see. What the Foz said, sure, retail traders will replace themselves with robots. LOL. Manuel said, I agree, especially for retail. Felix said, when are your memes and market streams? Every Tuesday and Thursday at 12 p.m. Eastern. Definitely subscribe. It's the most fun I've ever had. And if you enjoy any of the stuff that I put out, then you would have just as much fun and even more potentially. M3 Mastery Mindset Motivation. Love the name. It's pretty cool. M cubed. Don't you think there is a possibility that we see an emergency cut happening after the government reopens and publishes every week labor market data? That's possible. That was another thing that I didn't bring up that did come up in the conversation was like he said, once they got the revisions, they realized that the labor market wasn't doing as hot as they thought. Yeah, funny. Yeah, so that could absolutely be a real thing. I don't know if we would get an emergency cut per se, unless things were just that bad. Um, but yeah, so Cryptonomics said, yeah, we've had computers, but not robust AI that we have now. AI that actually learns. The traders of the past were too linear. With crypto volatility, those models had to be more robust. I bought it when Josh said I bought Palantir, I'm imagining when it was $20. Plan to sell soon. Wow. Congratulations, man. Yep. It's crazy. It's crazy. Usually when you see like because they pretty much went public, I'm pretty sure like not that long ago. Yeah. 2020. So like usually when you see a company go public like that, you very rarely see that company actually perform that short of a time from when it went public. Now, to be fair, it did go through a very large, downtrend after that IPO. It went down. It lost 86% of its value from the IPO high. Down there in the nines, it looks like, or no, down here even as low as sixes, high fives. So, this has been a rapid rise in the price of this asset. And to be fair, it's not overly surprising. I mean, what they're doing, right, in the collaborations that they have with the government, it just makes sense. So congrats to you for having, first off, made that investment in the first place, and then also being able to stick it out for this long. But anyways, guys, I think I'm going to go ahead and wrap this up today. Make sure that you subscribe to Memes and Markets down in the description down below. And we're going live every Tuesday and Thursday over there on Memes and Markets. It is a lot of fun, and we talk about like just the most fun topics and everything that's relevant in real time. So thank you guys for joining me today. Definitely be sure to hit that like button. And if you're new here, subscribe. Other than that,